Hi, this is Terry, and we're on Chapter 10, which is a difficult chapter because it involves bonds. But before we get to bonds, we have some other topics. This chapter is about long-term liabilities. And what we want to do is look at the accounting equation that are assets equals liabilities and owner's equity. And the question becomes, should we take on long-term debt? In other words, should we increase our long-term liability? There's several advantages and disadvantages to it. The idea here of an advantage is you don't have any new owners in the company, that what you're doing is generating cash, so you'd have a debit to cash and a credit to something like bonds payable. You'd pick up that extra money, but you wouldn't have any new owners. The interest is tax deductible, where dividends, if you would issue stock, then you would get cash, you would debit cash, credit common stock. That would be an equity method of financing. Dividends that you would pay out are not tax deductible. So it's better to use a liability for that purpose, for tax purposes. There's also a certain issue of financial leverage, and that's where your debt to equity ratios come in, that you need to have a balance between liabilities and owner's equity. Liabilities tend to be a cheaper source of financing by the time you take the after-tax cash cost of taking out loans. The issue is that there's a certain balance, and every industry is going to be different. So let's just say 100 equals 50 plus 50. So you have an equal amount of liability and equal amount of equity. Well, as this number goes up, and the percentage, done in percentages, as that percentage goes up, and maybe you become, 70-30, then you have a lot more financial risk because you owe a lot more people more money. Therefore, at some point in time, you're going to have a step graduation where your interest rate is going to start climbing. So if maybe you could get a loan for 8%, well, then it's just going to start creeping up to 9, 10, 11, 12, and go on up from there. The other issue is if you went the other way and went 30, 70%, then you may not have enough leverage, that you may be missing business opportunities. So that by taking out a loan, you could have expanded your markets, developed new products, etc. But the fact that you chose to be conservative and not take on a lot of liability, that can also hurt you. So it really is a trade-off. It depends on the company. It depends upon the economic times. It depends on, where the projections are of the market. I mean, it's a whole finance class unto itself, keeping track of all this. Again, these debt-to-equity ratios then become one means of you keeping track of how well the company's doing and how leveraged they are. The next major concept here is off-balance sheet financing. And here's what's going on with there, and it especially comes with this capital versus an operating lease. If you have a capital lease and you've got assets equals liabilities plus owner's equity, what you're going to do is you're going to go out and with a capital lease you're going to purchase a large piece of equipment and then take out a huge notes payable. And then what you'll be doing is you'll slowly pay off the notes payable and pay out cash. So your equity ultimately will go down here. In an operating lease section, which is your off-balance sheet financing, then what you can do is just record rent expense and cash. And the idea is you never, on your assets equals liabilities plus owner's equity, you never recorded that huge liability for buying a building, huge pieces of equipment, etc. And this becomes off-balance sheet financing, which was the whole Enron story. That's what caused them, that they had such huge legal obligations that never showed up on the financial statements, that nobody knew about until they started digging, until Enron collapsed. Full disclosure says that all of those items have to be, if it's not physically in the accounts, in the ledger accounts, then anything that's material must be disclosed in the notes to the financial statements. So again, it's a huge issue that all this off-balance sheet financing was there, but it was written in such a way that nobody knew what was going on, or didn't choose to know, or who knows what the real story is. It's a means of avoiding off-balance sheet financing, is a means of avoiding recording that liability. And there's 4 different rules that are involved. Off the top of my head, one of them is if you can't cancel the lease, then it's a capital lease, not a operating lease. If the value of the payments equals the value, the sum of the payments over the length of the lease, the life of the lease, equals the fair market value of the asset, then it's a capital lease. The moral of the story is if you meet any one of those 4 rules, you have to put it on your books as a capital lease. You cannot record it as an operating lease. An operating lease, lease again, is just recorded with rent expense. The next item here is pension funds and deferred taxes, and they become a huge deal here. I read your book on this one in pension fund. They're very, very complicated. Your book just goes to an overview, and the idea is, again, going back to assets equals liabilities plus owner's equity, you create this huge liability when you agree part of collective bargaining to pay pension to your employees, and that's a way of you attracting and retaining employees, is to promise them pension. And it's usually cheaper to the company because there's the concept of being vested. So if you start at point 0 here, and maybe it takes 5 years till you're vested, so the company takes money out of the paycheck of the worker and then matches that money. If that person quits, then that money that was matched just goes back to the company. They get to keep it. After 5 years, then all the money put in plus all that the employer matched, that all goes into a pension fund and grows so that you can pull it out and retire, and go live on the beach and drink margaritas. Again, it's a complicated topic. SFAS, I think it was 87 and 106 are the 2 major Statement of Financial Accounting standards that were passed to handle the post-retirement benefits, and 106 is all about health care. The deferred taxes, then, we've talked about in the previous chapter, where deferred taxes arise when, for financial purposes, you're using depreciation methods like straight line, double declining, and production method, whereas for tax purposes you're using acres and makers. Anything before 1986 is acres, anything after 1986 is makers, the modified accelerated cost recovery system. That difference then goes into deferred taxes, and that becomes yet another complicated topic, because if you put that liability on your books, assets equals liabilities plus owner's equity, and you have your deferred taxes in here, and then every time that asset is fully depreciated from a tax purpose, if you go out and buy another piece of equipment, you'll never end up having to pay off that liability. You don't have to pay it off. The difference between tax purposes and financial purposes is the timing. So if this is 5 years and this is 10 years or 12 years, whatever it is, after 5 years, for tax purposes, it's fully depreciated. Then you take no depreciation for taxes, but continue to depreciate for financial, and then at 10 years, the 2 of them cancel each other out. They have the same amount. But if you go out and buy a piece of equipment after that 5 years, you'll never have to pay that deferred liability. Again, it's another complicated topic that is beyond the scope of what we want to do in our book. The big issue in this chapter is bonds, and I would like to handle it by giving you some of the basics here then I have a bond handout that I would like you to download, see what you can do, and then I have the answers with all the calculations, so you have an answer key to the bond handout. I use it in the traditional classroom to get all the points across, because bonds get to be very complicated. There's so many different parts to it. The first issue is to look at this assets equals liabilities plus owner's equity once again. And the idea here is you're going to generate cash. You're going to generate cash by putting out a bonds payable. Bonds payable is a long-term liability. So here I live in the town of Normal. They went out to Interstate, out by Interstate 55, bought a huge amount of farmland, put in an 18-hole golf course. With that golf course, then all the lots around the fairways then were sold. It was a huge money generated because all the lots sold. It's a nice place to live. You look out your backyard. It's a nice mowed fairway, and the town of Normal needed the money to put the infrastructure in. So they had to put streets in, they had to put in the greens, the tees, the fairways, all that stuff, electricity, sewer, everything. So that's the reason that they issued the bonds, was to get this cash to be able to do it. Then their issue is by going and selling those lots, they sold the lots at a higher profit than the interest rate that the bonds cost them. So they put out these municipal bonds. Everything about the bonds, all the legal mumbo-jumbo, is called the indenture, and that's all the legal rights, claims, everything that an investor needs to know and legally has to know is in the indenture. That spells out when the interest payments are, etc. And the way a bond works is that, let's say you take out a 10-year bond. So we're going to divide this into 10 periods, and I don't know if I'm going to get 10, but we'll say that's 10. Then every 6 months, you're going to make an interest payment to these people. So let's say that you get $100,000 here. Then what you have to do is pay the $100,000 back at the maturity date, but along the way, you're making these 6-month interest payments to the investor. And that's where the investor makes their money. That's their return. So the amount that's in the indenture, that's stated in the indenture, is the face rate. The issue becomes that these are a legal right to collect money from the investor standpoint. The investor is going to put the bonds in their investment section. So their investment section as an asset. But the town of Normal issuing the bonds then is going to record the cash and bonds payable. So they're going to record the asset cash going up and the liability bonds payable going up. They're tradable. You can take these bonds, and if you want cash or you want to move into a different arena, that you want to sell your bonds and go out and buy shares of common stock, then you can trade them. So the market rate becomes an issue as to what are people paying for similar bonds with similar risk. So you turn around and say, okay, I'm going to pay 8%. Well, now what happens if another town the size of Normal out on the market in Pennsylvania turns around and says, okay, we're going to issue and we're willing to pay 9%? Well, how are you going to get people to buy your bonds when yours are 8 and other people's are 9? The only way that you're going to be able to sell them is if you sell them at a discount. So what you're willing to do is to record less money up front. So if I switch here with my percentages, I've got some actual numbers off to the side here. Let's use an example and say that we've got a $100,000 bond. Let me put this back to where it belongs. There we go. So we got a $100,000 bond, and that right now the face rate is 9%. The market rate, let's say that the market is 10%. So if you're going to do this 5-year bond, who's going to want to buy your 9% bond when they can go buy other people's bonds for 10%? Well, the answer to that is you accept less cash up front. So you would debit cash of $96,149. You would then use an account called unamortized bond discount for the difference of $3,851, and then put the bonds payable on the books at $100,000. So you're going to pay them $100,000, but you're willing to accept less money. That difference, that unamortized discount, is the difference between the present value using the 10% rate of taking that lump sum of $100,000 5 years from now and all the interest payments, and you bring it back. This is the present value at 10%. The bonds payable is what you have to pay, so therefore this difference of $3,851 goes in as a discount. Then what you'll do later, and let me erase this much, then what you'll do later, let me actually go down to a blank screen here, is that you will take that amount that you owe. Let me flip so I can have my numbers here. All right, to record this, then, our bond discount, then, again, let's recap that our bond discount was, let me move my stuff out of the way here. Our bond discount here was $3,851 divided by 10 periods, or $385 per period. So what we would record is the cash that we need to pay is principal times rate times time, which is $4,500. So we have $100,000 times the face rate of 9% times a half a year is going to be that $4,500. We're going to take $385 of that discount, so we're going to take that unamortized discount of $385, and now our interest expense for the time period is going to be $4,885. So what we need to point out here is this cash will always be the contract rate. Always, always, always. It's going to be principal times rate times time. That's what our indenture says. That's our legal contract. That's different than the expense that we record to our business. We're going to record more interest because of the fact that we had to sell at a discount. We're going to take a piece of that discount each period because of the matching principle, and we're going to take $385 every period for 10 periods and increase our expense. So ultimately, by the time we do this 10 times, we're going to make this journal entry every 6 months for 5 years, so 10 times. We're going to pay our investor their interest expense. They get their cash. Then ultimately, what's in this unamortized discount, it started out at $3,851, then we're going to take out $385, next time $385, next time $385, and continue down. By the maturity date, that unamortized discount balance is 0, and then not only will we make that last interest payment, but we'll take the bonds payable of $100,000 off the books and then pay the investor back the $100,000 that they originally gave us. This gets more complicated because we have to deal with, well, what happens if we sell at a premium? Well, it's basically the reverse logic. What happens if we pay 12%, but the market is only paying 10%? Well, then everybody is going to want to buy our bonds. So when we take the bonds payable and put it on the books, then our cash will be higher because we'll collect extra money, and our bonds payable then always goes on at the face amount. So we'll put the difference into a premium. Then we'll amortize the premium. The next issue then becomes, but what happens if, here's our 6-month payments, and this is all legal documents, so we have to make that first payment on a given date 6 months from the time that they're issued, but what happens if nobody buys it for 2 months? So, in other words, they're only going to have that bond for 4 months in their physical possession. So they shouldn't get interest for 6 months, they should only get interest for 4 months. So what we need to do is we will, and this will erase it so I have to redo my little example here. So 2 months and 4 months. Then what we need to do is we're going to record the cash and the bonds payable, but we're going to also have a credit to interest expense for 2 months worth of interest. So we'll put 2 months worth in there. Then later, when we make a 6-month payment to them, which is what we legally have to do, then the net is that they'll only get 4 months worth of interest. So in our interest expense, if they pay 2 months, and then we pay, if they pay us 2 months, and then we pay them 6 months, then the investor only nets 4 months, which is the amount that they have due to them. On top of this, then, you've got to run the last piece, which is year-end accruals. So what if you have a payment day here and a payment day here, but 12/31 happens in between? Well, now you have to, because of the matching principle, accrue 3 months here, if that's what the dates turn out to be, and then 3 months here. So since you're not going to make a payment, you still need to accrue the expense and the liability and make that adjusting entry just like you did when you learned the accounting cycle. So I think the easiest thing to do, because this is pretty abstract, and with trying to write on a screen it's not very neat or clean, is to go look at the bond handout and walk through each piece and go through it slowly so you understand what each piece is asking you to do. It walks you step by step. The first one is just a bond sold at a discount. So a bond at a discount. Then the next one is a bond sold at a premium. And then, I don't know, the third one is sold at the face value, but between interest dates. And then the fourth one gets more complicated, and the fifth one's more complicated, and then the sixth one is the most complicated. So walk through the handout, go through each piece, and then get on the discussion boards with anything you don't understand, and let me try and clear it up that way. All right, sorry that this isn't more than what it is, but again, it's a complicated subject, and it takes usually 2 to 3 class periods just to cover what bonds are and to go through just a couple examples, and we're trying to do it here in about 15-20 minutes. All right, thanks.